wanted to catch up with you what your thoughts are now, where we are, first bigger picture, and then we'll zoom into exactly where we are in the cycle.
Well, we are in the early stages of what is probably going to be a 2-year recession. So that's where I think we are right now. And the beauty about this call is that it is separates itself from the consensus view that we're going to experience a soft landing or a short and shallow recession. It could be shallow. It's not going to be short. That's where we are.
So I've actually come from a different perspective. I thought it's going to be sharper and shorter. Where's the length come from? Is it the length of the bear market potentially as earnings come down, or the recession itself? Talk me through that framework, how you've come to, because you're the first person who's really talking about a long recession. Where does that come from in your framework?
Well, it really comes from what the catalyst is going to have to be to get us out of the recession, which is, it looks like it started even earlier than I thought. I'll just say at the outset that although back-to-back negative quarters of GDP isn't the technical official NBER defined recession, it's a Wall Street rule of thumb because it always works. Whenever you've had back-to-back negative quarters, you've been in recession. Whenever you've had 2 quarters down out of 3, you've been in recession 100% of the time. So that's where we are. There's really no doubting it unless you want to attack the historical record. But you see, the reason why I think it's going to be long is because it's already started, and so is the Fed tightening cycle, just started in March. And the peak impact on the economy from whatever the Fed does, whether it's easing or whether it's tightening, there's lags involved because the economy ongoingly resets to a different interest rate regime. The lags are generally about 12 months. And the Fed only started raising rates in March, and they've gone a long way. They've gone 225 basis points. And even once they pause, they're still going to be undertaking balance sheet reduction. So they'll still be tightening policy even after they move to the sidelines in interest rates. And so once we acknowledge that we're in a recession, and I think it's going to take the consensus some time, because when you really look back, say, to the great financial crisis, the recession wasn't acknowledged really until Lehman collapsed. The view was that it was a soft landing. And you go back to the tech wreck, and people were surprised that the NBR actually called it a recession that started in March of 2001 and ended in November. The bottom line is that once you get into recession, you need a catalyst to get out. And there is no catalyst from fiscal policy. Fiscal policy continues to operate in a way that is contractionary for the economy. So the question is going to be, what is the catalyst? And I think ultimately the catalyst will be a move back to disinflation that gives the Fed the opportunity to ease monetary policy. But that's not going to happen immediately. And we have a situation where the Fed has been shamed because it blew the inflation call, chose the wrong word, because although they weren't wrong on transitory doesn't have a timestamp in any definition. But they panicked. The Fed, even in the face of back-to-back quarters of negative growth, and it's a debate as to whether or not Jay Powell saw today's GDP report yesterday, the Fed has been tightening into a recession, which really only happened during the Volcker era in the early 1980s, when you had back-to-back recessions separated, a year apart. You can almost argue that whole period was about a 3-year recession. And you have a central bank chief who in March, in front of Richard Shelby at a Senate committee presentation, Powell did not compare himself to Arthur Burns or William Miller or Alan Greenspan or Ben Bernanke. He brought up the fact that Paul Volcker was the greatest economic public servant who ever lived. And we know that Volcker killed inflation by killing the economy. So I'm getting a sense here that, what's remarkable, people are questioning whether or not the Fed is going to go again in September. Of course, now they're data dependent. They're no longer pre-committing. But the bottom line is that even in the face of this economic malaise, he retained a de facto tightening bias. And that speaks volumes because it tells me that it is going to take a lot to get this Fed to start to ease monetary policy again, which means they have to stop quantitative tightening and cut interest rates. I think that will be next year's story. And then there's going to have to be a lag because historically, the recession ends towards the tail end of the Fed easing cycle. The recession doesn't normally end in the early stages. And I can see people would be shaking their heads, what's he even talking about? But it's an answer to your question. We are in the early stages of a recession and the Fed is still tightening monetary policy. Why would anybody think this is going to be over quickly? The historical record is very clear. You need a catalyst to stimulate the economy once a recession starts. It's normally monetary policy. Frequently, it's been monetary and fiscal policy. Fiscal policy is out the window, and the bottom line is that it looks as though the Republicans are going to take the House and the Senate in November. There's no fiscal stimulus coming for a long period of time. It's all going to be on the Fed. And it looks as though the Fed's not going to do anything until it sees the whites of the eyes of inflation, headline inflation, heading back down towards its target. So you could argue they were late. They were late to tighten policy. They're probably going to be late to ease policy. But that tells me that when I trace through the lags between what the Fed does, trace it through to what it means for the economy, I think we're looking at a 2-year recession. I don't know so much about the magnitude. So much of that will depend, I think, on the extent to which we have a big negative wealth effect on spending. If the housing market joins the equity market in an asset price deflation, I think that's quite possible. The extent to which these high cash balances just stay as high cash balances on the household balance sheet instead of diverting its way into the real economy, which is what most economists and the Fed thinks. And so it's hard to say how deep it's going to be. I am probably have more conviction over its duration. And that's actually, I think, more important because there is no correlation between the severity of the recession and what the stock market does. It's much more important timing when the next recovery is going to start. Because historically, the stock market puts in the fundamental low 2/3 of the way through the recession, whatever that low is going to be. Will it be 10% down, 20% down, 30% down? The major point is that instead of trying to pick at what point we bottom, it's more important to identify when is the start of the next bull market. When will that start from whatever level it's going to be? And historically, that's 2/3 of the way through the recession. That is actually when people say that nobody rings the alarm bell at the lows. Well, actually, if you can try and time the contours of the economy through the lags from Fed policy, you can come up with a reasonable approximation as to when, as opposed to what level, but the timing of when it's going to be safe to dip toes back into the risk pool, outside of these intermittent bear market rallies. What's the fundamental low? The fundamental low takes place at the tail end of the Fed easing cycle and the tail end of the economic recession. So that's next year's story, probably second half.